Silver just touched its lowest point in an entire year, and somewhere, inside a private trading office, a senior commodities strategist closed his laptop and said only one sentence: "This is not a correction. This is a warning." Because what's happening right now has happened only 3 times in the last 50 years. And every single time, it came right before a move that wiped out the people who weren't paying attention, the Federal Reserve, the dollar, a newly appointed Fed chief under pressure. They're all connected, and they're all pointing to the same number, a number that, if broken, could send silver somewhere nobody is prepared for. So the question tonight is not whether silver will fall further. The question is, who already knows and who is about to find out? Before we go any further, I want to ask you something, like I'd ask a trusted old friend. If you've been with this channel for a while, you already know the value of staying ahead of these moves before everyone else does. So if you haven't yet, would you do us the honor of pressing that subscribe button? It costs you nothing, but it means everything to us. And it makes sure you never miss a warning like the one we're about to break down today. And one more thing, I'd love to know, where in the world are you watching this from tonight? Drop your city, your country, down in the comments. I read every single one. Now, let's get into it. Silver did not crash. It bled. That distinction matters more than most people realize. A crash happens in a single violent moment, the kind that makes headlines and triggers panic. A bleed happens slowly, week after week, while most people stop paying attention. By the time anyone notices the damage, the price has already fallen further than anyone expected. That is exactly what happened to silver this year. In January, silver touched levels that stunned even seasoned traders. Prices climbed past $120 an ounce, a number that just 12 months earlier would have sounded impossible. Analysts called it historic. Investors called it the beginning of a new era for precious metals. For a brief moment, silver looked unstoppable. Then it stopped. Slowly, the gains began to disappear. Not all at once, but in pieces. A few dollars down one week, a small recovery the next, then another drop. The pattern repeated for months, each dip slightly deeper than the last, until silver found itself sitting near $61 to $62 an ounce, the lowest price it had touched all year. Half. The metal had given up nearly half its value from where it stood at its peak. For anyone watching closely, this raised an uncomfortable question. If silver could rise that fast, how far could it fall? And more importantly, was this slow decline finished, or was it only the beginning of something larger? This is where most casual observers make their first mistake. They look at a falling price and assume it must be approaching its lowest point, simply because it has already fallen so much. They believe that after a big drop, a recovery must be close behind. History tells a very different story. Markets do not behave out of fairness or logic that feels comfortable to the average person. They behave according to forces that are often invisible until it is too late. A metal can fall 50% and still have room to fall another 20%. A price that looks cheap compared to its high can still be expensive compared to where it is heading next. This is why serious analysts do not ask simple questions like, is silver cheap now? Instead, they ask a more uncomfortable question. What does this pattern of decline usually mean, and what has it meant in the past? When researchers studied previous moments where silver dropped sharply after a major peak, a pattern began to emerge. These slow, grinding declines were rarely random. They were almost always connected to larger forces working quietly in the background, forces tied to currency strength, interest rate expectations, and shifts in investor confidence. The price of silver, in other words, was never really about silver alone. It was a reflection of decisions being made far away from any trading floor. Decisions made by central banks, government officials, and policymakers who rarely explain themselves in advance. This is the part of the story that most people miss entirely. They watch the number on the screen. They do not watch the machinery turning behind it. And that machinery, according to people who study it for a living, has been sending signals for weeks. A senior commodities strategist, someone who has spent decades watching cycles like this one, put it simply. He said the current decline did not resemble an ordinary correction. Ordinary corrections are choppy, uneven, and unpredictable. This one was different. It was steady. It was patient. And patient declines, in his experience, tend to be the most dangerous kind because they lull people into comfort right before the next sharp move. That is the uncomfortable truth sitting underneath this story. Silver is not simply falling. It is testing something. It is moving toward a price level that many traders consider critical, a level that, if broken, could open the door to a much steeper drop than anyone watching the headlines is currently expecting. For business owners, investors, and anyone paying attention to where money is moving in the broader economy, this is not a story to glance at and forget. It is a story about how quickly confidence can turn, and how the forces driving silver lower may already be shaping decisions far beyond the price of a single metal. The real question is no longer how silver climbed so high. The real question is, what is waiting for it now, just below the surface, at a price level the market has not tested in months, and that level is closer than most people think. To understand why silver keeps sliding, a person has to stop looking at silver itself and start looking at something else entirely, the value of money. This sounds strange at first. Silver is silver. It sits in vaults, it gets shaped into coins, it gets used in factories and electronics around the world. How could the price of money have anything to do with the price of metal? But this is exactly where most people lose the thread of the story, and exactly where serious analysts begin paying closer attention. Every commodity, including silver, is priced in dollars. And when the dollar gets stronger, something predictable tends to happen. Silver gets cheaper, even if nothing about silver itself has changed. Think of it like two sides of a scale. When one side rises, the other side falls. Right now, the dollar side of that scale has been rising. It has been gaining strength against other currencies around the world. And that strength has been pressing down on silver like a weight nobody can see, but everyone eventually feels. Why is the dollar getting stronger in the first place? This is where the story turns toward decisions being made far from any trading floor, inside government buildings and central bank meeting rooms. For months, a quiet debate has been unfolding among economists and policymakers. The question at the center of it is simple to ask, but enormous in its consequences. Will interest rates rise this year? Two camps have formed around this question, and they do not agree. One camp, made up largely of political voices, argues that rates should stay where they are. Raising rates makes borrowing more expensive, which can slow down economic growth, something no politician wants to be blamed for. Their argument is built on caution and short-term comfort. The second camp, made up largely of bankers and economists who study inflation closely, sees things differently. They argue that inflation has been creeping upward, quietly eating into the value of everyday money, and that rates need to rise to keep it under control. Their argument is built on long-term discipline, even if that discipline causes short-term pain. Caught between these two camps sits something new, a freshly appointed head of the central bank, chosen by political leadership, now facing immense pressure from both sides. Officially, central bank leaders are supposed to act independently, free from political influence. But independence on paper does not always survive contact with reality. A newly appointed leader, owing his position to the very people hoping rates stay low, faces a delicate balancing act between economic responsibility and political loyalty. Most analysts believe rates will eventually rise, simply because inflation leaves little choice. But they also believe that rise will come with visible reluctance, delayed as long as possible and smaller than what the data alone might justify. This single decision, whenever it finally arrives, ripples outward into everything connected to money, including silver. Here is why. When interest rates rise, ordinary savings accounts and safer financial instruments like certificates of deposit start paying out more. Suddenly, money sitting safely in a bank earns a return it didn't earn before. For investors holding assets like silver, an asset that pays no interest at all, this creates a quiet but powerful pull. Why hold a metal that earns nothing when a savings account down the street is suddenly paying something? This is the mechanism working underneath silver's decline. Not panic, not collapse. A slow, rational shift of money chasing a better return elsewhere, all while a stronger dollar makes silver itself appear more expensive to buyers using other currencies. What makes this moment particularly important is timing. This rate debate is unfolding at the exact same time silver sits near its lowest point of the year, already weakened from its retreat off January's historic highs. Two pressures, a strengthening dollar and looming rate decisions, are now pressing down on silver from different directions at the same time, with neither one showing signs of stopping soon. For business owners and investors watching from the outside, this is the part of the story that separates casual observers from serious analysts. The price on the screen is never the full story. It is the visible result of decisions, debates, and pressures happening quietly behind it. And right now, those pressures all point in the same direction, down. The only question left is how far down this combination of forces is prepared to push silver before something, somewhere, finally gives way. There's a number that traders rarely say out loud in casual conversation, but quietly watch with more intensity than almost anything else on their screens. For silver right now, that number is $60. Not 59, not 58, 60. To understand why a single round number can matter so much, a person needs to understand something about markets that has little to do with charts or formulas. Markets are made of people, and people respond to round numbers in ways that are not entirely rational, but are entirely predictable. Traders call this a psychological floor. It is not based on some hidden mathematical formula buried in an economics textbook. It exists because enough people, all at once, have agreed, without ever speaking to each other, that this is the line that should not be crossed. Buyers gather near it, hoping to catch what feels like a fair price before prices recover. Sellers watch it just as closely, waiting to see if it holds or breaks. As long as that shared belief holds steady, the floor holds steady. The moment enough people stop believing in it, the floor disappears and prices can fall through it with surprising speed. This is exactly the situation silver finds itself in right now. According to people who study these patterns for a living, two very different outcomes are sitting on the table, and both cannot be true at the same time. In the first scenario, $60 holds. Buyers step in exactly where they are expected to, treating this level as a genuine value point rather than just a number on a screen. Silver stabilizes, the bleeding slows, and the market begins to settle into a calmer, more predictable range. Under this outcome, the worst of the decline is already behind it. In the second scenario, something darker unfolds. The floor breaks. And once a psychological floor like this gives way, the drop that follows is rarely small or gentle. According to several experienced market watchers, if silver falls below $60 with real conviction, the next meaningful support may not appear until somewhere in the low 50s, and depending on how far momentum carries, possibly even further than that. This is not a wild prediction made for dramatic effect. It is based on a pattern seen again and again throughout commodity history. Round number floors do not crack quietly. When they break, they tend to break with force because the same crowd psychology that built the floor in the first place turns instantly into panic the moment it gives way. Adding to this tension is something that has nothing to do with charts at all: timing of year. There is a well-documented seasonal pattern in precious metals markets, one that experienced dealers and analysts have observed for decades. Summer months tend to bring quieter trading. Fewer buyers walk through the door. Trading volume slows, demand softens, not because anything dramatic has changed, but simply because attention shifts elsewhere during these months. This seasonal slowdown does not cause big problems on its own, but when it overlaps with an already fragile price level, like the one silver sits at right now, it removes one of the few forces that might otherwise step in to defend that floor. Fewer buyers means less support. Less support means a floor that was already shaky becomes even easier to break. This is the uncomfortable reality facing silver as this story unfolds. A critical psychological level. A seasonal lull in demand. Two opposing camps of analysts, one expecting stabilization, the other expecting a deeper slide into the 50s. All of it converging at the exact same moment. For business owners and serious investors, this is precisely the kind of setup that deserves close attention. Not because it guarantees disaster, but because it represents genuine uncertainty at a moment that matters. The next move in silver will not be decided by hope or by how the price should behave based on past highs. It will be decided by whether $60 holds. And right now, nobody, not the analysts, not the dealers, not even the people closest to this market, can say for certain which way it will go. Every market story eventually arrives at the same question, not where will the price go next, but what should a sensible person actually do about it? This is where the story of the silver stops being about charts, floors, and central bank pressure and becomes something far more personal. Consider a situation that played out earlier this year, one that quietly illustrates the real danger hiding inside this story. A couple, hoping to buy a home later in the year, decided to place part of their down payment savings into silver. At the time, prices were near their historic highs. The logic seemed reasonable on the surface. Silver was performing well, and the couple believed a few more months of strength would only grow their savings further before they needed the money. Then the decline began. By the time they needed those funds for their home purchase, the value of their silver holdings had fallen sharply, far below what they had originally put in. The home they had been planning for slipped out of reach, not because they made a reckless decision, but because they made a timing decision. And timing decisions involving volatile assets carry a risk that is easy to underestimate until it is too late. This is the lesson sitting underneath everything discussed in this story. Silver, and precious metals in general, were never designed to behave like a short-term savings account. They do not move in straight, predictable lines. They swing, sometimes violently, based on currency strength, interest rate decisions, seasonal demand, and psychological floors that can hold for months or break in days. For a long-term holder, this volatility means very little. Someone planning to hold silver for 10 or 20 years can watch it swing from $60 to $100 and back again without it threatening anything important in their life. Time smooths out the noise. Patience absorbs the swings that would otherwise feel frightening. But for someone tying a short-term goal, a home, a tuition payment, an urgent expense, to an asset this unpredictable, every swing becomes personal. Every dip is not just a number on a screen. It becomes a delayed plan, a missed opportunity, or, in the case of that couple, a home that no longer fits the budget they once had. This distinction matters enormously for the business owners and entrepreneurs watching this story unfold. Capital allocated for near-term obligations, payroll, rent, expansion costs, should never carry this kind of volatility risk. That kind of money belongs in stable, predictable places. Capital that can sit untouched for years, money truly meant for the long run, is where assets like silver earn their place, precisely because time is the one tool capable of smoothing out the very swings being discussed throughout this entire story. So as silver hovers near its yearly low, testing a psychological floor that may or may not hold, the real takeaway has very little to do with predicting next week's price. It has everything to do with understanding what kind of money should be exposed to this uncertainty in the first place. The forces pressing on silver right now, the dollar, interest rates, seasonal slowdown, are not going anywhere soon. They will keep pushing and pulling at this market for months to come. What separates those who come out ahead from those who get caught off guard is not who guessed the bottom correctly. It is who never bet something they could not afford to lose in the first place.